Canadian General Investments is quite an old investment trust. It was launched in 1930 in this form, marketed largely to British investors investing in what was at that time an emerging market, Canada. It is, as the name suggests, a general Canadian equity fund. It's diversified across the Canadian market, more diversified, in fact, than the Canadian market is itself, as the Canadian market skews heavily towards financials, energy, materials. And we'll certainly have exposures to those and potentially large exposures when that's appropriate. But typically we are more diversified than the Canadian market is itself, and it's actively managed, so we are in fact trying to beat that index. I think Canada gets overlooked often by people outside of Canada. They tend to lump it in with just investing in the United States. And if they think to have an exposure to Canada at all, it's either in sort of a North America fund, which is fine, but really that's just a US fund then with maybe one or two stocks exposure to Canada, or it's someone has bought the Royal Bank of Canada and maybe something else, maybe Suncor. In fact, there are a whole swath of companies that are available to investors that wouldn't be in any of those funds necessarily. You have to remember Canada is a major economy, it's part of the G7, and there is a whole universe of companies that are world-class and worth investing in. As well, you have to remember the Canadian economy has actually been managed very well. We didn't have a financial crisis. There's no housing collapse. There are no bank failures, and it sailed through, and it's led the G7 in terms of GDP growth through the crisis and out. Job creation is now trailing the United States a little bit, but it's number 2 in the G7. And net federal debt, it's also the lowest in the G7. There is some worry with Canadian housing because, of course, unlike everyone else, we didn't have a housing crash. People think that the housing market is a little inflated and maybe due for a correction. And I think a correction could come, although even there, what you're really looking at is just 2 cities. The rest of the Canadian housing market looks reasonable. Vancouver and Toronto are certainly very high valuations, but in terms of people's ability to pay their debts, the loan serviceability ratios seem very good. And on top of that, it's a different structure than you had, say, in the United States, where in Canada, there's no non-recourse lending. So people can't just walk away from their mortgages. The majority of the loans are kept on the lender's books, and people aren't incentivized to have as large a mortgage as possible because mortgage interest is not tax deductible. So in fact, people pay off their mortgages in Canada typically, and there just isn't the sort of mortgage arrears that you see in other markets. That said, the Canadian consumer is largely tapped out because so much has been spent on housing. But the Canadian economy has actually been very robust recently in the last several years, and there's no particular reason to think it wouldn't be, unless concerns about NAFTA pan out. In terms of NAFTA, the Trump administration came to power saying that they were going to scrap the whole thing, or at least renegotiate it on terms that were highly favorable to the United States and not favorable to Mexico and Canada. However, the Canadian and Mexican negotiators' tactic seems to have been to draw things out, and now you're starting to see political pressures come to bear on the US administration, as well as interest groups and lobbies within the United States that realize that scrapping NAFTA entirely would hurt the United States as well. There haven't been too many changes to the portfolio just yet. In light of the current correction going on in markets, you might see us make some moves. I think really about 1.5 years ago, we made a major change to the portfolio, and that really worked out well. As you saw, the Canadian index was only up high single digits last year, whereas Canadian General's NAV was up 22%. So that was something we thought things were working very well. Some changes that are a little unusual, we have a higher than usual component of US stocks, and part of that is we've added 1 or 2 names, as well as a couple of names like Amazon, Apple, have done very well for us. So I think that if a crisis were to continue, the correction were to continue, that might be a source of cash going forward. Our attitude to gearing is that it's a nice thing to have, but it's not a thing we have to have. We've employed it since 1998, and traditionally we've had what are called hard refractable straight preferred shares outstanding. So this is really 10-year debt that qualifies preferred shares, and we had them with staggered lives, so it ended up being semi-permanent capital. When the most recent issue came due in 2016 for redemption, the preferred share market didn't look attractive, and we were happy enough to let it lapse. As I said, gearing is a nice to have, it's not a need to have, and if the coupon on the preferred share was not going to be attractive, we didn't want to do it. As it was, a group of Canadian banks approached us about a term debt solution where we didn't have to worry about them calling it before the due date, which is we always worry about with debt. The bank calls it at the worst possible time. So we replaced the Series 4 preferred share with the term debt, and we still have another series outstanding until 2023. We'll monitor the situation. The term debt comes due in about a year and a half, so we may let that lapse, we may roll it over, we may do a new preferred share. We'll assess the situation at the time. The past performance has generally been quite strong, although it is a long-only geared fund, so it can move around a little bit more than you'd expect just sort of a straight index fund too. So we certainly had a very good year last year in 2017, up about 22% versus high single digits for the market. And we're ahead of the market over the 1, 3, and 5-year periods. The 10-year periods, we're trailing the market still just a little bit, which is part of the consequences of the financial crisis feeding through. But the very long-term performance of the fund remains intact, with Canadian General beating the market over the 25 and 50-year period. Our dividend policy is to pay 2 kinds of dividends, and this is due to the tax status we have as an investment corporation. So we pay dividends out of dividend income, so that's the income in the portfolio, and we pay dividends out of net realized capital gains. So those are capital gains that we've realized in the portfolio, and we net them against realized capital losses, and then we pass out those as dividends to our shareholders. In the past, we used to have a 5% yield target where we'd pay 4 quarterly dividends out of income and then pay a year-end special capital gains dividend that, together with the 4 quarterly dividends, would work out to current yield of 5%, give or take. We've been moving away from that policy over the last 5 or 6 years, and we've been gradually raising our quarterly dividends while holding and shrinking our year-end special dividends while holding the total distribution static. So this year we paid, as we have in the last several years, paid 76 cents in distributions, but the year-end special was only 4 cents. And I think it's probably reasonable to expect that that would be the last year that we pay a special on a regular basis like that. Going forward, they should be all quarterly dividends, but that doesn't mean that they'll all be paid out of income. They will still be a blend of income and capital gains, as that's the most tax efficient within the fund, and for investors is most tax efficient, as capital gains in most jurisdictions are taxed at a lower rate, and if you're outside of Canada, there's no withholding tax on the capital gains.